Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, June 14th, 2019. What I want to do is just hit on briefly a few of the things we've been watching lately, some of the big asset classes. We'll look at the equity markets, crude oil, gold, treasuries, maybe I'll touch on natural gas, time permitting, and again, just kind of hit on those lightly. Before I do that, I want to share my thoughts on something, or at least give you a heads up on what to maybe expect for the next few days here, next few trading sessions. Yes, we're heading into a weekend now, but then next week we pick up with the FOMC meeting on deck. This is our right side of the chart support center. This is, if you're not familiar with this page, there's a lot of links here. Some of these will change if you're logged in. The account settings will change when you're logged in or not. But what stays the same down here, you have the tools of the trade. I've had these links on the site for years. Very, very useful things that I use all the time. This economic calendar, for example, if we click that, we're going to look here. It'll open up an economic calendar. It'll give you a week at a view, a week at a glance here, and we're on Friday. So you'll see they put these color-coded dots. Red dots are the potential market movers, the most important reports to watch. You know, these aren't going to move the markets really if you don't have any dot by it. The green ones are important, could move the market, but again, it's the red ones you really want to focus on. So you can see, for example, we had retail sales today at 8:30, industrial production, and then a couple other reports there. But the big thing is next week. So let's click in. We'll go into next week's calendar. We have the FOMC announcement, the FOMC meeting. They started on Tuesday, and at 2 p.m. on Wednesday, they come out with their decision as to whether they're going to cut rates or not. So we'll see. And obviously the decision's important, but even more so what they say going forward. And a couple takeaways. Number one is most often during big or potentially market moving, or what I call important Fed meetings like this one, where the market's kind of hanging on every word and there's been a lot of buzz about what the Fed's going to do or not going to do. This is an important meeting. They meet several times a year. Some of those meetings are lame duck meetings where we know ahead of time they're not going to do anything. And there's other meetings where, you know, there's 100% probability of a rate cut or a rate hike or anything like that. They will usually announce it pretty well in advance, and you can look at the futures. It'll tell you the probability of or the options, I should say. It'll tell you the probability of a rate hike. Either way, let's not get to that. The point being that the market tends to hang up and kind of trade around in a sloppy sideways trading range leading up to that. Anything can happen. Something could jar the markets. Maybe it could be a technical breakout or breakdown before, but they usually don't go too far. So keep in mind on that too is you tend to get whipsaw signals. What I mean by that, let's just say you're watching, you know, some kind of chart pattern here. Let's say it was a W bottom and you're looking for a breakout to the upside on a stock or the market. And boom, you got it on, let's say, Monday or Tuesday, and the market starts to go up. Well, from my experience, more often than not, that breakout will fail because any breakouts that trigger right in front of a big FOMC meeting are likely to be whipsaw signals because nobody wants to take a big position. So you tend to see trading volumes drop down, and again, the markets kind of slop around, and when you're slopping and chopping around sideways like this, what does that do? Well, it tends to create whipsaw signals on certain stocks that might be in a chart pattern. Let's say you have a little wedge pattern, you get a breakout, but that breakout may have just been induced by the back and forth noise. So the takeaway, at least for me, is keep things light, be very selective. Not to say you can't enter a trade. It's not to say a trade won't work out. I'm just saying that from my experience, you tend to run a higher rate of breakout failures and whipsaw signals leading up to the Fed, and frustration too from your positions going back and forth. So that's that. We'll be watching that, and so I'm sure a lot of people will heading into next week. And then keep in mind as well, when the FOMC announcement comes out at 2 p.m. about the one guarantee that you'll have if you're watching the 1-minute charts, you know, and it's going like this, you're going to see these super sharp rips and dips. You know, that's the algos trading, you know, the computerized trading programs will fire off, and they're trying to interpret, and they're parsing the words, going through the data, everything that's been said in the announcement. And from my experience, be careful there. The initial reaction is very often faded, and even then, the subsequent reaction is often faded as well. Bottom line, you get sharp back and forth rips. What I tend to do, if I have any positions that are close to my profit target where I want to get out, let's say I have a profit target, down here at whatever number you pick it, and it's a short trade, I'll leave that in place because my goal on every trade is to have my profit target hit and not have my stop be hit. So I'll leave that in place, but I will temporarily suspend a stop if it's close and allow for a whipsaw. Yes, that can dig me in a little bit deeper hole, but more often than not, when I've done that, it has saved me because I learned over time from experience that I had trades that would just get clipped if they were close, hit the stop, and then go on to play out exactly as expected. So that's, and again, you have to take that on a case-by-case basis, see where you're at. But I just wanted to give you those takeaways. And again, that's in the immediate minutes and hour or so following the announcement, and then the dust usually settles the next day or two, and that's when the market will decide and finally pick a direction. Where's it going to go from there after the meeting? So until then, unless anything big happens technically or a big fundamental catalyst comes out in the market, don't expect a whole lot of the market going up or down very sharply until next Wednesday. Also, another tool that I want to continue to point out. Earlier this year, I created these two position size calculators. I actually customized these, made these myself, and they're very useful tools. I'll see comments where there's frustrations on a trade that's only down 1-2% against where we entered it, and if you're feeling pain on a trade, really on any trade, at least the official trades that I put on the site, or any trades you take on your own. But if you're in a trade and it hasn't exceeded the suggested stop, and you're feeling pain, chances are you put too much into that trade, too much of your portfolio. So this position size calculator will help you. It'll give you an actual dollar amount, how much money you're willing to risk in your portfolio. 1% is a good number. You can go higher than that, but you shouldn't have half your money in a portfolio into any one trade, especially an individual stock that's not a diversified index or anything like that. So use these and don't focus on the dollar signs if your profit target's hit. You should want to look at that. That all plays into your risk-reward ratio and everything else right here. But what you want to look at is if this thing goes against me and my stop is hit, how much am I going to lose in dollar terms? How am I going to feel with a loss of X dollar amounts? And this will help you figure that out. So again, that's on the support center. Now let's move on and look at the charts. All right, we'll start out again. Quick overview of the markets. There's SPY, the S&P 500 tracking ETF. So we had the bearish engulfing candles on Tuesday, but now it seems we're already locked into sideways trading. So the range started a little bit early. We did have the confirmation red candles, but we've been moving sideways now. Not the ideal scenario for the bearish engulfings. I'll just say that. Doesn't mean they can't play out, but ideally you want to see prices reverse from that point. So let's just not read too much into all this. QQQ also moving lower since Tuesday's candle. It didn't put a bearish engulfing, but it's the only index. Everything else did. But again, we're staying, so far that has the potential makings of a top. Maybe a buying climax there, but we'll see. Again, here's a trading range that has to be resolved. That's the bottom line. So when you zoom down to the 60-minute charts, you can see. And so I highlighted recently we had some potential flag patterns, bull flags. Now they're foiled. This is how the flag looked. We had the impulsive breakout, and now that's been faded. So these are not playing out as such. And so really all this is, let's not try to make too much of it at this point in time. It's just a trading range. And that's what the market does. It consolidates. The market tends to make big moves. And every so often it will consolidate. Sometimes those consolidations are a continuation. It's just the market taking a breather on a strong run up with another thrust. And sometimes those consolidation ranges mark a top. After the consolidation, there's more the sellers and buyers, and you go down and trend reverses. So that's pretty much it. Now you can see we're kind of tapping on this level here. I've had it for a while, 180, 179-ish. There's a top of that, the smaller flags that we had recently, And if that level goes, we can tighten that up a little bit. You can see those candles are a little bit above that. Let's do that right now to come in and capture these reactions there. I'm talking about that candle, that candle. So that's it. That's it. So the market's dancing around and may continue to dance around. And even if it breaks down today, tomorrow, you still have support here. You still have resistance on the way up as well, the recent highs. And so again, you know, this is what I'm expecting to happen into next week, but we'll see. Maybe traders get either bullish or bearish leading up to the Fed, and they want to get out of position. So I just wanted to say that I don't have a very strong read on where the market goes today or in the next few days. It hasn't changed my outlook where I think it's heading from here. I think the range will resolve to the downside with the possibility, and I'll tell you that's another thing too, is it would set up. Remember, I have that scenario here. It's not my preferred, it's my alternative scenario that we pop up, put in a marginal new high, which will be a divergent high like this, and then reverse. Well, that might mesh with an FOMC announcement. I mean, we'd have, well, take all the way to Wednesday, but again, we could come down here and then do it. So there's a lot of possibilities. I'll just have to update the charts and my thoughts if and when things start to materialize that way. All right, so that's QQQ. Let's go back to this board. That's the board I wanted to look at. And then SPY 60-minute there. Same thing. The flags have been pretty much foiled because we haven't had. There's plenty of time to have an impulsive follow through. We didn't, and we're just so far lackluster trading. So I'm really, I view those as foiled bear flags, which, if I want to give a check mark to the bearish case, I'll do that because the bulls had an opportunity to break that out and run. If it was a healthy market, when I say the bulls, if the market had healthy, demand in it right now, more buyers, more willing buyers and sellers, that would have and should have played out that way. But the fact that it didn't tells us there's a failed bullish chart pattern breakout so far, and that in itself is bearish. Now, we haven't gone down below the flags. That would be the next step, but just wanted to bring that up. Futures, I'll just hit on them. Look like a mess. When I say a mess, it's just, you can see we had clean trend lines. It's, everything was, technicals were playing out well because the markets were moving. They were trending. We had a downtrend here. We had an uptrend line at which to keep shorting at, and also to watch for a breakout when the time was right. When these divergences told us that the next tag of that trend line would probably result in a breakout in a rally versus another rejection, as it did early in the trend. And then we set up with this trend line here. So that's when you're trending, and this is when this is the thing about trading. I see frustration again in the trading room at times that positions are either going slightly against some traders or just not playing out fast enough for them. I always say this, that in life, patience is a virtue. In trading, patience is an absolute must. Markets aren't always going to trend. In fact, they spend a lot of their time consolidating. And so after the breakdown here, that's what we've done. It's traded off these levels pretty well, but this is just a sloppy sideways trading range, and it's not going to continue forever. So, but as of now, that's what we're looking at. There's ES, same story. There's the breakdown, the divergent high, which foreshadowed or foretold of a likely correction. We came down, we hit my 2865-ish target. We bounced right back up to that 2900 again, which we had overshot just briefly on what I refer to as a momentum-fueled overshoot. And so the technicals are playing out. It's just kind of we're sloppy. We're stuck right now in what I call no man's land. That means smack in between support and resistance. And so obviously bulls want to see this, bears want to see that. And that's still what I favor. Okay, let's look at a few other things. This being one of them, crude oil. Crude oil is, I often refer to this as a trendy little sucker. And what I mean by that is crude oil doesn't spend a whole lot of time consolidating. You either have these clear, bullish, pretty strong trends, uptrends, or downtrends. That's been the nature of crude, at least in recent years. And even within the uptrends, you have these smaller micro trends that are pretty unidirectional. You see just all red candles, all green candles, red candles. So like I said, crude picks a direction, and it likes to stick with that direction until it reverses, and then it likes to go the other way pretty sharply. However, and this plays into some comments too I've seen on the site recently, especially in the trading room, about options trading. Now, look, I've traded options for many, many years. I'm not a big fan of them. I don't trade them often anymore. From my experience, the majority of my trades in the past were more often than not losing trades. You get up. I know the leverage factor is great. You see dollar signs when you say, man, if I get this trade right, and I'm going to use an example here. So let's say, oh, okay, Randy showed a chart, or I think, whatever. You think that crude's going from here, you think it's going up or down or whatever it is. And so instead of positioning with the shares, trading futures or ETFs or individual stocks for the trade, you decide to go with options. And the thing about that is, I can do a pretty good job overall on looking at a chart if a chart's clear to me. I can't 99, out of 100 charts I look at, I don't have a strong opinion or any idea where the stock's going. That's why I'll give an opinion on stocks. Sometimes you guys ask me for my opinion on a stock, and I say, look, I just don't have a good read. Here's what I can see, but I don't, have much of an opinion. If I do have an opinion, it becomes then a trade. Crude, oil. I was clearly looking for a reversal, a big trend reversal here, just like back here when we broke these trend lines, just like we had these divergent highs. And in fact, we positioned for it short. So I want to use an example here now as to why I'm not a big fan of options. So we shorted crude last time as an official trade right on the break of that trend line I just showed you on the daily chart, that big wedge. And this is it zoomed in on a 60-minute chart. So we broke down, we back tested, so I held off on the breakdown, waited for the kickback rally, got it, nailed the entry right there at 13.29 on April 30th. Now, what happened from there? I had 3 targets on this trade. This T2 was revised because we gapped down below the other target, so that's where our second target was hit. But you can see I had these targets here where I expected something along the lines like this. Come down, hit that first target, which we did from here relatively quickly. We went and we gapped down right to it. You can see that. And so the first target was hit. And I would have expected something along these lines. T1 down to T2 and down to T3. There was a little downtrend line that was actually forming. See that downtrend line? So that's what I would have expected. Now, had I played options and tried to not give myself a little extra time, which I do, I'll say that. If I am going to trade options now, if I'm going to just do a straight, not a paired trade, just a straight put or call buy, I will guesstimate when my security will get there, but then I'll add another month or two just to be safe. Yes, you pay up for that time, and sometimes you can pay dearly, and sometimes it's not worth it. So sometimes it might be considered an option on a trade, and I'll check the premiums. If they're too fat, if volatility's up, or for whatever reason the premium's too high, it's not worth it. Because you got to get the call right, not only where the stock is going. So let's say you bought a put around the $12 level. You thought it was going to 12.15, and if you paid up, a big fat premium there, you may have hit your profit target. And I've seen this happen before, and the damn options hardly even moved because most of what you paid was that premium up front. And the other thing here, this is what I wanted to get at. So I showed you how I would have expected USO to play out. And I was right on the call and where it was heading, but guess what? It got locked into a sideways trading range after breaking down that lasted almost a month. Here's from May to late May right there, and then boom, the trade continued to play out impulsively and as I expected, and we went on to hit our third and final target there, and crude continued to drop. So that's an example of why options can be very tricky. As I always say, it's one thing to get the call right on where a security is headed, in the future. That can be, hard enough. And then to try to nail the timing on when it's going to get there, that brings in just a whole nother degree of difficulty. So that's my thoughts on options. And if you guys trade options, no problem. Yeah, I can give you my opinion on a stock where I think it's going. I can try to guesstimate the time. Just don't ask me, Randy, should I buy the June blah blah blahs or go with the Julys? That takes a lot of work in analyzing which options contracts to buy. There's tools your brokers have, and it's a lot of work and time, and it's also another reason I don't trade them as well. Yeah, or at least not very often. So there's USO. Oh, and while we're here, USO at support on the. This is a pretty decent support level down here, about 1060 or so. We've been dancing on it. You can see a lot of reactions there. Some reactions over there. Um, PPO is starting to curl up. It hasn't made a bullish cross. These are things you look for. We are oversold, or recently were. We're coming off oversold readings. Doesn't mean we can't go down lower. Just something to watch. Last time here, we were oversold at this point, and PPO made a bullish cross, and we had a little kickback rally, but then boom, another thrust down until we put in a divergent low. So I'm near term cautiously bullish, but I'll tell you, a lot of this depends on what the stock market does, I think, because there's been a pretty tight correlation between crude and the equity markets. Crude's been much weaker recently with this drop, but overall, going back for the last few years, this is what crude futures look like. I posted this chart in the trading room this morning. I updated this. I have a downtrend line, a potential downtrend line here. We have, now another reaction, so that helps to validate it. There's 1, 2 reactions, 3 at that point. Now we're there again. So we may get a fourth reaction or a breakout. So if you're trading crude or looking to trade it, remember we put in a bullish divergence right here. We had a divergent low and a bullish falling wedge, which broke out, I think it was last week I posted that, broke out, ran up here to that 54.76 level. This level I just added, I didn't have that on my chart before. This is now resistance because we have a few reactions. It's also a potential price target if we pop up here. So crude is certainly consolidating, and it's going to go one of two ways. It's going to consolidate and maybe break to the downside, have another thrust down, or an upside break. With the Fed on deck for next week and the market likely to chop around, hard to say if this is going to break out, and if it does, hard to say. But that's a pretty nearby target. So I think it's a fairly safe bet to say a pop above the trend line and impulsive breakout. And you have some minor resistance here, about 53.50 that it has to clear. That could pop you up to about 54.76 and possibly more. This would be right now, let's just say a max bounce target up here on about 58.55 for crude if that bullish scenario starts to play out. And here's an updated chart of crude's close cousin, natural gas. They tend to come out of the ground together. There's this one, we have an official trade. Remember, UGAS is an ETN. I don't put futures on as the proxy. I'll update the chart and I'll mention those and give you these targets, and because I know a lot of traders like to trade futures. There's a little support level right here that's been holding so far. Comes in wherever that comes in. I don't have the line. You can see the recent lows, and so far a pretty nice lift today. Nat gas is up about 3.18%. At least these futures are. So what you want to see, and I'm still expecting, I still favor it. It wouldn't be an active trade. We just went long after the breakout of this bullish falling wedge, but that's it. So you had the divergences. We had an initial thrust up, correction. We've held support so far. We're moving up impulsively now. We need to take out that previous reaction high, and then I still have my next target up here at about 2.425, and then this is my preferred swing target right now. There's certainly potential for more, but that's what we're looking on, and that should roughly correlate to with the UGAS target, which is UGAZ. We already hit T1 before. We're back to it again. And same story. So just like if you don't have futures chart, and you can get those, you can look at you can get free access to futures, real-time futures charts through investing.com. Might as well just create an account there, and then you can save a watch list, put all these in there. You can track nat gas, futures, all that stuff. And sometimes your broker, TD Ameritrade, offers futures quotes on their Thinkorswim platform, even if you're not trading futures. That's another option for you, and some other brokers might as well. So that's it. We need to pop that recent reaction high, which I still think is likely. Come on up here, hit that second target, and then head on up there to that third target. And we may or may not get a reaction at T2. That's not a big level. I would expect a minor reaction, but who knows? It is resistance, so TA 101 says it's resistance until it's taken out, and the initial tag usually gives you a reaction. But you really want to watch the nat gas futures, because that's all this thing is trading. This thing is not buying. UGAS, the company Velocity Shares, isn't going out and they're just buying natural gas futures, the same futures I just showed you. And of course they're leveraged up three times, but that's a lot less than a nat gas futures contract, by the way. You put 10,000 in here and 10,000 your money in NG. NG is going to give you more bang for your buck because of the leverage factor. By the way, and I've mentioned this in the site too recently, there's an option to NG if you like you like futures, but you don't have the capital for NG. QG is the micro or mini. It's a smaller, reduced size futures contract, and it goes off the same price levels as does NG. So if you want to trade futures because you like the fact they go around the clock, you can avoid big gaps down. You don't see gaps here on this chart, but when we go back to UGAS, because it's an ETN, let's just show you what some of these gaps mean, and that's why I adjusted the position size down substantially on this trade. That gap right there, what I did, I grabbed from where we closed the previous day, and then we gapped down the next day to, let's see, where did that candle open? That candle opened at 21.38, which was the high part of the candle. Yeah. Okay, so that was then a gap down of about 6%, and that's just one. I'm just picking one example. You can see plenty of those here. So that's why one reason I like futures is if I had a stop in between there, I would have been stopped out overnight or somewhere a tighter stop and not been caught in that 6% gap down. Gold, I still remain bullish and have been, other than that, get out here, and we had an active trade, I believe, on it, looking for the pullback, and kicking myself that I just never got around to adding it as an official trade. Although many times I said, it's a scale in from here down to here, and all the way down to this level. That would be a scale in zone, and 120 probably being the most significant support level on the chart. Just so many reactions. So it went there. And then we took out the downtrend line. It just continues to go up. Now it's coming up to my my 130 target. Again, the long-term scenario, this has been laid out for over a year now, is this chart here. A breakout when we were down here, run up, break above the triangle. There's a big symmetrical triangle, downtrend line right there. Come up to this 130 level. So at this point, the risk reward is starting to get less favorable. However, I feel pretty confident that whether we have a meaningful, lasting reaction or a deep pullback off 130, I believe it'll be taken out. And it's possible we go right on through there. Sometimes you go through resistance. So although not an official trade, it's just one unofficial trade I continue to update, I continue to like. I think it just makes a whole lot of sense. I'm a big proponent of asset allocation. Asset allocation means that this is your portfolio. You have pieces of the pie. You should not have all your eggs in one basket. Some pieces of that pie might be gold, some might be long or short equities, some may be treasury bonds or corporate bonds, or commodities such as wheat and coffee and corn, things like that. That is the key to investing. That is the key to swing trading, asset allocation. And with the way we are, and most likely very likely in the very latter stages of a business cycle, possibly the early stages of a contraction, gold and flight to safety assets, alternative assets, certainly makes sense. It's not the time anymore, I don't believe, for a 100% equity portfolio, as it was from 2009 up to 2018. Well, I shouldn't say 100% equity portfolio. I mean, just a concentrated portfolio with a lot of long equity exposure. At all points in time, again, there's opportunities elsewhere besides equities and commodities, everything else. All right, let's move on to the next one. So there's gold. Near term, like I said, it's getting close to 130, but and it does have some divergence here on the 60-minute chart. But that's all about the U.S. dollar. It's not all about the U.S. dollar. Here's the thing. Gold's been strong lately, and the dollar had broken out before. It's coming back in here. What we need is, when I say the dollar broken out, the euro US dollar has broken out. But as I told you guys, I was reluctant and holding off because that 130 level, it didn't get taken out with conviction. Look, so far we rejected. Now what's going on? Gold has been strong despite this. And what this is, by the way, the euro US dollar is just looking at the dollar chart in reverse because the euro is the biggest component. I like to use this chart. And so now we're getting to the point where I may add gold soon because we're back testing. We broke out as I expected. I said we had resistance here. Just traded on it for about a week and came back down. Now we're back testing. So if this pans out, where I'm going with that is this is the pretty much the dollar in reverse. And so you can look at UUP, which is the dollar ETF. And again, this is why I was looking at this. This is the dollar index ETF. We had a breakdown, but it was not impulsive. And then we snap back above there. See, when the dollar breaks down, this will be a major sell signal, a major top in the US dollar. And a falling dollar is bullish for gold because, as the dollar drops, it takes more US dollars to buy an ounce of gold. And that's why gold and the dollar, and I've laid charts in the past, overlaid long-term charts, the correlation is unmistakable. It is an inverse correlation between the dollar and the gold. One goes up, the other goes down. There are always, with any correlations, temporary disconnects where you'll see, gold, for example, lately moving up with the dollar moving up as well, like today. Don't worry about day to day or week to week. Again, you pull that, you can do it yourself, your charting program, throw up a chart or put up a chart of UUP and gold or GLD, and you'll see the relationship I'm talking about there. And there are, again, periods of disconnect, but it's a pretty strong one. So that's what I'm looking for. And gold's still on watch for an official trade, but still I think makes sense in your portfolio for a piece of the pie right now. So that's that. I covered, let's see, crude oil. What did I want to hit here? Oh yeah, treasury bonds too. I've been throughout since heading into last year, bullish and long. We had the long trade on the site, and then again on treasury bonds. But at this point in time, let's just say I'm neutral. I don't have a strong opinion. Neutral to bearish, because we had the TLT trade, TBT short trade. We were long treasuries, and I'd been long, 401k long-term money. It's big part of that, and 401ks and stuff like that throughout until just recently when we hit those targets right here. I've taken most, not all, but most of that money out of treasuries right now. I don't think the risk reward is favorable. Why? Well, a couple of reasons. Number one, we did hit my long-term target. Again, just like gold, where I've been looking at this one going back into last year. We had this bullish falling wedge pattern right here, and my prediction was we go on, break out of that, which we did. We hit the 122.50 level, which was resistance, back tested a couple times, consolidated, next thrust up. I mean, the technicals have just played out. They couldn't play it out any more perfectly. These are all levels that were identified in advance. That's a big resistance level there, and you can see it acted as resistance. Once broken, what happens? Resistance becomes support. So we had a pullback there. There was another opportunity to go long, a very objective long entry on the pullback to support, and then boom, the final thrust up. And again, what we hit is a back test of this very long-term trend line. So that's resistance. And so I think at best, now the thing about trend lines and back testing, just like right here, it's not always a one and done. Sometimes you can back test for a while. And so again, I'm a little near term kind of mixed on this. If my scenario for the stock market plays out and we're going to take another big leg down, it's hard to imagine that treasuries don't rally. So it's possible we come on through here, but maybe I'm wrong on the stock market. Maybe the stock market's going to new highs, and if so, I could tell you the treasuries would certainly, I would expect a considerable drop in treasuries. Wouldn't happen right away, but a major trend reversal. So there's treasury bonds, and again, the trend right now is bullish, plus the outlook, or at least my outlook for the stock market, is bearish. So right now that doesn't mesh with the a short on the trade. We tried it recently. I was caught the rally in the stock market, but we just didn't get much of a pullback in treasuries. Just like gold too. Gold has been holding up, and it tells me something. It tells me that a lot of institutions, smart money, are moving money into these safe haven assets like gold and treasury bonds. I could sit here and do an entire other video solely on macro fundamentals on the economy. There is just one indicator after another rolling over. So I think the stock market, I could tell you, The Fed isn't gonna turn this ship. If the economy has topped and it's going to roll over, low interest rates, especially after so many years of low interest rates, it's not gonna help things. And stock market's going to play a pretty violent game of catch up to the downside if the economic indicators continue to roll over at the rate they have been recently. So that also goes into my analysis or outlook for the equity market. All right, let's wrap it up here. This video's been long enough, but that's the main asset classes, and there's other things out there too, and I'll maybe cover those in separate video, junk bonds, things like that. I'll keep an eye on, but for now, let's just expect some possible choppy sideways trading for the next few sessions heading into early next week, and then have your ducks in a row because that's where the fireworks start after Wednesday. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.